Hello and welcome to NDTV Profit. You're joining us here. We are at Aloha, very close to the Kochi airport, of course, where we're at the Federal Bank headquarters. And I have with me Mr. Shyam Srinivasan, the MD and CEO of the bank. Mr. Srinivasan, thank you so much for taking time out and talking to us. Pleasure, honestly, always talking to you. I want to start this chat with what is now has become about a 14-year-long tenure at Federal Bank. And obviously you've seen through cycles and cycles within the sector, but you've also seen cycles at Federal Bank. Tell us a little bit about what these 14 years have looked like.
Oh geez, I didn't realize this is going to be like a 14-year story. But yeah, it's been, let's say, fascinating. If you take it in slices of time, the first 5, the next and the next, I think the nature of how Indian banking and how regulations in banking have evolved have been fascinating, right? And we've seen it. Second, we all know technology is driving change. The distance between technology and banking is narrowing, or where one ends, the other begins. It's now we're living it. I recall in the early part of 2000, the decade starting 10, we used to say technology will dominate. Now I think it's become real. So between comparative forces, emergence of new technology and invasion of technology into banking, regulatory changes that are at times ahead of some of the changes and or keeping pace, a lot has changed. What I can say, and I think the bank has come out well through all these phases. And if there's one thing we take great pride in, is we've been fairly scratchless in these years and come out without doing things that have happened without disturbing the furniture, so to say. So in some ways, I feel relieved that we are recognized for being a bank that's credible, consistent, and growing. And I believe that this will be our platform and our calling card for greater success. So yeah, I'd like to believe we've made good progress.
In an era of some cowboys out there, we've been true to the banker name tag. I just want to bring the focus on Federal Bank as an institution now. So what was originally a more old generation regional bank, today, of course, is a pan-India lender. Most of your business comes from outside of Kerala. I wanted to understand from you in terms of the way the business has expanded. What has been a focus strategy for you, at least over the last couple of years, where the world has come out of COVID and things are starting to look a little better now?
No, I think to understand that, we have to go back to what our roots are, right? We have been traditionally very strong on NR and SME, small business lending, small and medium-sized business. That has been the core. And because of that, we've been deposit rich. And we've done well. So through our expansion phase, we always believed that we must preserve this. And this inherent skill of the bank, we can carry across the country. So if you broadly map the world of remittances or world of NR money coming into India, principally it was Middle East, Kerala. And in that corridor, we dominated a large share. That was and hopefully is our strength yet. But we realized that the non-Middle East, non-Kerala, Middle East, non-Kerala, and any part of that quadrant are all growing quite nicely. And therefore, we positioned ourselves in our expansion into geographies where NR remittances are and deposits are a large part. So if you take Tamil Nadu, Maharashtra, Karnataka, parts of North, this is where the bulk of the remittances ex-Kerala comes into India. So we created our catchment in these geographies. So over the last many years, now we are 1,500 branches. About 900 branches are non-Kerala. And these are all in these geographies. So in most of these states, Tamil Nadu, we have 250 branches now, and the other states have about 150 plus minus. So these have become our conduit for getting non-resident. So the core strength of Federal Bank moved into these geographies. But having been present in those areas, with our lending skills in small and medium, we'll be able to capture the commercial banking, business banking order. Then around 2015 middle, we created the whole corporate banking capability, which was not our core strength. Then, over the last 8-9 years, Harsh and team have built a remarkably strong corporate franchise. So today, thankfully, you mentioned that we are a pan-India franchise. One thought, and that's been a pervading thought, is never have too much concentration in a geography, segment, or product.
Okay.
So if you see our business mix today, it's almost one third between corporate, retail, and commercial.
Right.
And depends on where you put the ticket size. You could say retail is about 55 and corporate is about 45. So we've tried to keep that balance going. And in that construct, we've created the franchise in such a way that in most geographies, we have now physical footprint to get retail domestic deposits. And over the last 8-10 years, our non-home market, Kerala deposits, have grown at a reasonable clip. So we are able to fund our credit growth through all this. And of course, post-COVID, these have been accelerated. We in 2011 and 16 expanded our network by we doubled it. Then between 16 and 19, we said we'll go more digital, less physical footprint. Around 20, we started our expansion. COVID came, so we halted it for 2 years. So that 22, 23, 24, the last 2.5 years, we've added almost 250 branches. The one that went by, March 24, we added 140 branches. That was, I think, our largest single year expansion that happened. And we believe between now and the next 3-4 years, between 5 and 7% expansion each year is something that's going to happen. So footprint expansion, presence in many geographies. And I think presence gives us the right to be at the discussion table. Right? Both physical presence, digital presence, and more importantly, our corporate and commercial team are more feet. They are out in the market. So I think our presence combined by this strategy has worked quite well.
So you mentioned this point that you don't need to be, you don't want to be concentrated in area or product, right? Any single area or product. Does this apply even if it's your home market or whatever, a place where you were founded as a lender?
No, I mean,
the local community typically expects that a lender that was founded there would be there, or the
this
majority.
This is not a either or strategy; it's an and strategy.
Right.
We are very prominent here. Hopefully, will continue to be prominent and have meaningful presence. But any one geography has limitations, and it's not going to be a infinite opportunity. If you compare to the India opportunity, no one state will give you more than 3 to 5%.
Correct.
And which is therefore, if we take Kerala, it's about 3.5% of India's GDP. There's that much you can do. And we will play our largest share. We have 15-16% market share there. And we must remember that at 15-16, the incremental market share gains are that much more tougher and that much more challenging, right? Because next bank or next competitor is not going to let you just
keep going.
This is the commercial dynamics work so. So I think our presence here remains prominent. And there's no reason we should lose our, actually not even prominent, dominant, and we will continue to be so. But like I said, these are not either this or that. It's both. There's nothing to suggest that we are under-investing here and growing somewhere else. We will do more. Like last year, for the longest period, we had not added footprint. Last year, we added about 12 branches in Kerala, which was now a requirement because a lot has happened. Particularly in North Kerala, our presence was relatively lower than, say, Central and South. So we said we'll add more presence. And that also happens to be a catchment, which is like a lot of non-resident comes in. So I think it's a continuous evolution, but I just want to mention that it's not either or, it's an and strategy.
Okay, fair enough. Okay. Now coming to specifics in the business, the strategy with respect to your corporate portfolio, something that you started later in the life of the bank. How do you see the current environment? Because most banks are reporting a significant jump in their corporate credit growth. You had the regulator come in with a draft regulation which upset some people. At least they won't admit it on record, but offline they do say that it's a little onerous on the project financing draft guidelines that they put out. what do you see? Where does this corporate credit growth go from here? Because companies have stopped spending their own money now, and they are tapping other sources. How does this go from here?
I think, see, the two parts, right? One is, I think, for us, as it has been in the recent few years, a corporate credit, and when I say corporate, I mean the higher end of commercial banking also.
Yes.
Like, that is our sweet spot. Will grow, and it will grow well into the teens and maybe even higher teens, right? Mid and higher teens. One, our base is relatively small. Between corporate and commercial, we're still about 100,000 crores.
Yeah.
Right. So I think scale and opportunity is there. Second, we built a team which is really high end. Third, the technology capability we are putting in there matches the best. In fact, as we speak, the rollouts of different phases of our next wave of tech for corporate is underway. So scale opportunity is there. Now, whether these can be at 20% or 18% or 15%, actually it's going to be dependent on your resource raising capability as opposed to the opportunity. The opportunity is there, and all said, our market share is sub 2%. Right? So if India keeps growing at 6 to 7%, which is not an unreasonable expectation, corporate will grow between 12 and 15%. We are a low share player, so we can grow well north of 15. So whether we grow north of 15 or at 15 or slightly below is going to be dependent on cost of resources. In FY24, our corporate grew somewhere in the teens. We let go of some assets which were really at the lower end of the pricing curve and booked some new. If I had not let go, we would have grown 20%.
Okay.
I believe in the year and the years ahead, that is possible, right? And now whether we grow at 15 or 14 or 20 depends on ability to raise resources at the right place. What we have told ourselves, and if you see our book for long periods of time, the A and above rating dominates our book.
Right.
There is a conscious trade-off you're making. These guys will not pay us big pricing. The only way we can get more from them is being a banker as opposed to a lender. So in the last 2 years, Harsh and team, what they have done is made sure that the corporate relationships that we have, we are able to get more from them as opposed to just being the fifth or the fourth lender to them.
Right.
I think our overall product capabilities have matured to a level where they are willing to give us a larger share of their wallet. So I think corporate will continue, just not lending, but full banker, including payroll, savings account, vendor financing, their whole supply chain. And I think as we scale up and improve our capabilities on technology, I do believe this will be a large opportunity. And goes back to my original point, we do want to stay reasonably equally weighted across business, because one thing I can say with some confidence over the 15 years, cycles will come and go. Those who keep honest to their core structure have come out better through cycles. I believe we've come out better. If you take a CAGR of our growth over this period, it's 15% CAGR.
Right.
I can reasonable confidence say no other bank has had this over an extended period. They may have had 25, fallen off, come up, and I think ours has been a fairly sustained story.
Stable.
Therefore, my belief is reinforced by the fact that we should stay in businesses. Yeah, you'll have to dial in, dial out depending on the environment, but not like get out of a business and, because then you're not a banker. Then you're a good fair weather friend. Then it doesn't live up to our expectation of Rishta and, perfect banking partner. So I think we are trying to live that.
You have a liabilities base, what now? 2.5, little more than 2.5 lakh
2.6 lakh crores.
So I'm curious to understand one of the few lenders at this point in time who has a wider gap between your advances and your deposits book. How long can this situation continue where banks are growing their deposits, but they're not growing it fast soon enough as much as your credit is growing? And then obviously that's pushing your CD ratio higher and it's making a lot of people uncomfortable. How long can this continue?
Business model. We have told ourselves early 80s should be our CD ratio. We don't want to violate that. And I think we've fairly stayed honest to it for long periods of time. We are blessed with a remarkably good retail franchise. Though it has come down, bulk has gone up, but certainly never in the level that many others are. And that will not change. And yes, we have to calibrate some credit to support the, if we are growing credit 18-20%, we must grow deposit 18-20%. At least 17-18%. Even through the toughest period last year and the previous, we grew that kind of deposits. Term deposits is a pricing, and it's relatively elastic to pricing. We believe we can grow, and we have. The traditional low-cost deposits, CA and SA, that has seen some up and down, and I think some of the core areas of non-resident money coming in, some behavioral change of clients have taken place, and I think it looks at this point in time quite irreversible, which means our retail nature of our deposits from being 90% will become 80%, but that I think we will ensure. So I believe growing at our scale between 16-20% depending on the year on both credit and deposits is possible without violating our 80-82% CD ratio.
What is this change in behavior you're referring to?
I think post-COVID, visibly, the NR behavior on deposits has changed. Probably paying off earlier debt, investing in many who are returning are probably setting up businesses, so the money is going into that, paying off debt for family, wedding, education, starting new businesses, putting it into the markets. These have become more prominent than it ever was. So I think the remittance volumes coming into India has still remained robust. You would have seen $110 billion came in.
Not a lot of it is finding way to the banks.
Comes to the bank. We are now 21% of remittances comes through us. So we are a prominent remittance conduit.
Correct.
But it doesn't go into bank deposits as much as it did earlier. If 21% came, you could say with reasonable confidence 16-18% would stay at deposits. Now it's coming more like 13-14%. So some money is going into the instruments I told you, either to pay off debt, start a new business, going into the markets, or for consumption, because we are seeing consumption pick up. And so while it's not a deposit, it's coming through as credit expansion.
Got it.
So we are seeing that happen. New property.
Is there a pricing point as well here?
On deposits?
Yeah, on these NR deposits.
No, but
anyway, they're higher than what they would get in the domestic markets.
No difference. NR pricing is the same as domestic pricing.
No, I'm talking about their domestic.
I think that also, I think that arbitrage is coming down because interest rates have remained high in many other markets. So converted into rupee, they may not be seeing much of an opportunity.
So maybe that's why.
That also could be.
Got it. Let me talk about the retail lending business a little bit. We have seen some changes coming in within the entire banking sector. The RBI has come out in November with those specific guidelines saying that, listen, you need to increase the risk weight on these loans. That has made some banks more cautious. Others are saying it doesn't look as bad as one would think. What is your viewpoint? In the current space, is unsecured still a lucrative business?
If the credit quality doesn't dramatically change, at this point it doesn't look like, unsecured will remain a very good business. For us, it's a very small part of our overall. Of our 2.1 lakh crores, our cumulative credit card, personal loans, and microfinance, assuming these are the three, is 10,000 crores. So it's still sub 5%, sub 4%.
Right.
But it's growing at a nice clip, and I believe it will grow at the same rate. But on a growing denominator, from 4%, it may become 5-6%. So I don't see it as on our windscreen, it's not going to be a big worry. But having said that, we should watch for the delinquencies and the slippage rates in that. I think genuinely with the bureau and the underwriting skills improving, it hasn't deteriorated. It's still holding reasonably well. If this continues, then there should not be any panic. And anyway, we are providing sufficiently for it. So if a business has predictable 3-4% loss rate, is not a worry. If a business has 0, 1, 2, 3, 4, 5, 6, 7 kind of escalating loss rate, you have to worry. My sense is, and I think mentioned to you last time in my interview, I started my career in unsecured.
Yes.
And I've seen unsecured over last 30, 35 years.
Yes.
I've seen that the predictability of a portfolio depends not in your collection. I think that's useful, is when you underwrite. Now with underwriting skills of banks and the bureau quality improving and so much third-party data being available, I think this is now getting to be more predictably good quality. That said, if somebody is going to be very sort of cowboyish and say, I am going to ignore all this and lend at any cost, yes, you will face some pain. But I think the banks are being quite thoughtful about it.
Okay. I want to bring up sort of an elephant in the room kind of a question of your tenure and the way the last year, a little bit of, I would say, at least for me, as somebody who tracks the bank, it was a bit of period of confusion, and then now some clarity is emerging. I wanted to get a sense from you as you look back on everything that has happened over the last 14 years, and now there is a definitive date that's coming up. What would you say was probably the big highlights of your tenure this year?
Oh. I certainly have not sat and thought about that.
Too much work to do today.
Yeah, not only that. I think about this. I think it was 2015 in our board. We agreed our aspiration is to be the most admired bank, and we took that as a very brave call, because when you tell yourself you want to be the most admired, you are putting yourself on a treadmill, because whatever you do is never good enough. Right? And I have personally, my philosophy is I am happily dissatisfied. I'm never dissatisfied, but I'm never unhappy. And that's a philosophy, and I try to build it as a bank culture.
Right.
I don't want complacency. I want us to be happy, but I want to be dissatisfied. And if you add that back to our most admired bank philosophy, we are telling ourselves we are on a treadmill. Whatever you do is never good enough, because admiration is bought and not earned. Today you will like me, one wrong act, you'll put me back in the boondocks, right? So we are pushing ourselves. So if you take that as our philosophy, I think over the years, we are struggling to get to the space where, a Federal is the best in class.
Yeah.
I did point to you, CAGR of our bank over
Correct.
many periods of time. We've been relatively scratchless. We've taken balanced calls. But it comes at the cost of being called a boring bank.
Yeah.
Right? My favorite all time is Rahul Dravid. Right? And I've said this very often. And I regard him as somebody who's credible, consistent. You can look up to and feel reassured that you're talking to a man of great credibility. And I do believe Federal is in that space of being credible, consistent. Can we do something more? Yeah, we could have. Will we do more? Absolutely, yes. But I think if I look back with some satisfaction, the fact that the platform is strong. We have built a great team. When I joined, our bank's average age was 47. Now the average age is 35. Every year we get 1 year younger. I don't know how many organizations will get younger each passing year, because we are recruiting almost 15 to 1600 people. We are retiring 300-400 people. So the number of people in the system is increasing, and all of them are in their sub 25s. So the average age of the bank is getting younger each passing year. Naturally, in a younger digital environment, the energy levels are different level. So I think we are positioning ourselves for a nice outcome.
Great. Then the related question to that would be then your successor. There has been a lot of speculation, some of it thanks to us, but what do you see your successor coming in and doing, or at least what's your hope that your successor comes in and does?
No, I think, like I said, I think we are a good platform. There are definitely areas of our bank that have to get much better. For example, despite all the hard work, our NIMs are amongst the lower end of the spectrum. It's a choice. We decided to keep our NIMs relatively lower, but thankfully our credit costs are way lower. So the risk-adjusted NIM is amongst the best in class, roughly 3% odd.
Right.
But having said that, there is a scope for NIMs going up. So certainly the leadership team of the bank will look at how does NIM expand, right? And if that NIM expansion flows to ROA, nothing better. So we've moved from 0.7% ROA in 2018 to 1.32% in quarter 4. I don't know if many banks have, without a scratch, moved the ROA by 60 basis points increased in a 6-year period. We said every year 10 basis point kind of improvement, and we delivered. Now, if that momentum continues, we should be close to 1.6, 1.7 in the next 3 years, which will put us actually at the top of the pile. So I'm hoping, I remain a shareholder of our bank, right? So I will hopefully benefit by the good work done by the team. And, I think we are in a promising.
All right. The final question I wanted to ask you: anything that's in your agenda when you started out here, that's probably still something that you've not left unchecked?
All are work in progress. I'll tell you, and it's a conscious call. Not that I don't want to be satisfied, but I'm telling myself I should not be. Long way years back, I attended a program in the London Business School. A professor of mine, a professor called Don Sull, very good he was. So the day your leader is either satisfied or starts building an office with fountains and all, quit that organization, right? So I have held that true to myself. Anytime the leadership, and I tell my team, if your leader is overly satisfied and or starting to do stuff that is looking very page 3, quit that organization.
Yeah.
So I think our bank it goes back to boring. It's good to be boring.
Good to be boring. All right, Mr. Srinivasan, thank you so much for taking time out and talking to us.
Thank you.
Pleasure talking to you again, sir.
Thank you so much.
Thank you so much.